All right. Welcome everyone to our October webinar. This is a series that we started back in January. Our investors with their investing journey. We try to share different topics and get feedback from our investors of what they like to learn about and how can we bring more resources to the table. So today we will be talking about interest rate and where it's going and the impact of that on real estate, and especially with the latest decrease in interest rate and that pickup in movement in the real estate market. As always, we like to start with a disclaimer that this is a webinar for educational purposes. Please do not make any investment decisions without consulting with your legal and financial advisors and asking tons of questions when we present deals. So today is only education. And with that out of the way, today's goal for us, like I said, I want to talk about the recent movement in the interest rates, the impact on the real estate market, and what we're seeing this gonna do for the market, for our investment strategy, and what we bring to the table for our investors as well. Before I get started, I'd like to pulse the room a little bit about your current level of experience in commercial real estate. Some of these topics may be heavy or light to some. So I'd like to get a pulse if you can share in the chat your experience in commercial real estate and your awareness of interest rate impact on it. All right, so we have a mix of experience levels, which will make my job harder because I'm gonna try to keep it easy and hard at the same time. Okay, so let's get going. So first, what are the current trends in interest rates and their impact? For commercial real estate investors who does this on a daily basis, we are excited about the recent movement, and finally the market is started to see that impact just in the past few weeks. So a little bit of recap on the current interest rate trends. As many of you may have heard in the news that the Federal Reserve slashed interest rate by half a point, and that's a big deal. They were anticipating a quarter of a point or a half a point as the economy started to slow down to stimulate the economy again. And so that's the first interest rate reduction as they were watching inflation peaked at 9.1% in June of 2022, after all the stimulus money and the printing frenzy, to about 2.5 last month annualized. So they keep monitoring the inflation and job market in terms of new jobs offered in the market, and that's kind of like what they're looking at. And they are signaling more cuts in the future. So what does that mean? It means that it's a delicate exercise that the Fed works on. They monitor the economy. As the economy slows down, they're going to start to reduce that interest rate to stimulate the economy again. The economy has been hot for a while, and inflation has been hot for a while. So they've been trying hard over the last couple of years to increase the interest rate and slow down the economy. And they were really anticipating layoffs and anticipating a reduction in inflation. They keep saying that they want to hit 2% inflation as their target. And I'll show you historically that was tough. It's normally 2.5 to 3 when things were steady. But that's what they're aiming for. But also, we shouldn't be too excited about the recent movement because the September job report showed another surge. So that might slow down their anticipation of the market has cooled down. Maybe it didn't cool down all the way, but it started to show signs of that. A little bit of fun facts. Obviously, the Federal Reserve's direction isn't national debt, isn't big picture. They're only focusing on two things: inflation and employment. That's what they're looking at. That's their metrics to make sure that that's their objective, is to keep the market stable in terms of prices and to continue to stimulate the economy. And these two, if one is higher than the other, they can cause issues in the economy. So that's what they do. If the market the economy is hot and everything is growing, inflation will start to pick up, and they monitor that from job growth and from the inflation side. They increase the interest rate to slow down the economy until they see that they need to stimulate it again. Inflation followed the inflation that was right after all the stimulus in COVID in both administrations. The stimulus has caused the inflation to go wild. And right after that, it took them a while. They should have acted sooner, but they started raising the interest rate, sorry, to attack inflation. But that lag cost us to wait for about 18 months to see that impact on the economy. So that's what they do. They continue to set those benchmarks, and they continue to adjust the dial to hit that 3% inflation and continue to grow the economy without having any recessions. So that's in a nutshell what I was talking about. Higher interest rate suppress the growth and combat inflation. When inflation start to fall, they start slowing down on the interest rate to stimulate the economy again. So if we look at it historically, over the past recession, I would say, you can see here that interest was very low and it started to pick up ahead of the financial crisis in 2007, 2008. And once the economy collapsed, they reduced the interest to almost to zero. And we've been sitting there for about 8 years. And that's what created a lot of expansion in the economy, a lot of investments by the different firms, and that continued to expand the economy. But we haven't seen any inflation associated with that because a lot of this was recovery first. And then as the economy started to get hotter, the interest rate started to climb up, but nothing was crazy. Everything was manageable. And you can see here it's gradual and controlled, just quarter of a point at a time as the economy was growing. And then COVID hits. And when COVID hits, everything shut down and they started going back to maximum stimulus, printing money, almost zero interest rate. And that created a lot of recovery first and then a lot of market activity because money was very cheap. So a lot of a lot of aggressive investing behavior we started to see in 2020, 2021, and 2022 because money was cheap and the cost of capital was almost negligible, and people started to making bigger, riskier decisions as they were going through that. And then as inflation started to rise in the beginning of 2022, this is the fastest spike of interest that has ever seen in the United States history. So from zero to five, five and a quarter, five and a half, even within a very short span. I would say probably 15 months. So that's the fastest break in the economy in the U.S. history. And they were kind of freaking out because they really wanted to see layoffs. They really wanted to combat inflation. And inflation took a while to calm down. And we still see growth in the economy from a job market point of view. So that's why they were like, should we increase it more? Did we do it too late? Did we do it too fast? That was always the concern they had. But they kept it there for a while until they saw some of the inflation go down, and now they're actually started to drop. So we expect a trend of drop, but nothing fast this time, because the last thing they want to see is another round of inflation, because that's just gonna tell the market that they didn't do it right again and they have to wait more and continue to pause the economy. Inflation over the years, as you can see, averaging 2 points in the good years after the collapse, and then the jump of 7. This is annual rates. At some points, we've seen 10, 11% month to month, and then it started to slow down. They want to hit the 2%, but they're not able to. So that's kind of what their target is. I think they're going to be stagnant around 3% unless they, and with the pressure that they want to move the economy forward. So if they continue to hold it where it is now, we may not hit that 2%. We'll see. So what's the impact on commercial real estate, which is what matters to us? Just kind of a quick recap of what determines the value of a property in the commercial real estate. When we buy a property, when we build a property, when we sell a property, the valuation of a property is the net operating income. So all the income minus all the expenses divided by the cap rate. So cap rate determines the value of the property, and cap rate is associated typically with interest rate. So for every dollar you generate as a business, cap rate will determine what's the value of that dollar. Is it a risky business? Is it a stable business? And I'll show you a chart kind of differentiating impact on offices, industrial, multifamily, retail, but pretty much they follow a similar trend. So if you look at the light blue color here line is the 10-year treasury chart from 2005 to 2022. And all these lines are the cap rates for the different segments in the commercial real estate. And more or less, all of them follow the interest rate with a lag. So as you see here, started to drop. The interest rate started to drop. The cap rates had a little lag before it started to follow the interest rate. And so this is the market reacting. And if I want to simplify it in English, if the money is cheaper to borrow, the value of the properties will go up. And that's what it's happening here. As cap rates goes down, the value of the property will go up. So people will start borrowing more money and make higher offers, and the market prices just picks up. There might be some exceptions to certain asset classes that are related to the market, maybe operating expenses, hurricanes driving insurance up in certain cities, taxes. So you may see some variations between maybe an apartment complex versus an industrial. Office supply is severely oversupplied. Office spaces are probably going to take a decade for demand to catch up with supply. So tons of vacancy. You'll see worse performance of offices, for example. But more or less, real estate is directly correlated with interest rate, unlike other businesses where they have more sources of, I would say, they're normally less leveraged than real estate, and they're not as impacted by interest rate. Think of a CFO in a corporation, the decisions they make on operations point of view, they're not necessarily impacted by interest rate. Definitely capital expenditures and any investment decisions by CFOs for growth and expansion would be impacted, but not as real estate, where leverage is very high on debt and we're directly correlated with the interest rate. So typically when we look at the finances basics of what do we look for when we finance a deal? Do we look at fixed rates, variable rates, the loan terms? Those are the dynamics of financing when we look at a deal. How much cash are we putting down? What type of loan are we taking? Is it fixed rates? Is it variable? When does it matter? When is it favorable to do one of the two? And what are the general loan terms? So if you look at the fixed rates, it has its own challenges and advantages. So when the interest rates are expected to be rising, like we saw in 2022, having a fixed rate right there and then it would be great, because you would lock in your rates and continue to be fixed and avoid any variability and risks in the financial market. But if the interest is dropping and we anticipate it to drop, having a variable rate may not be a bad idea to follow that trend. Obviously, each comes with its own risks. But also we look at the terms. Well, what is the prepayment penalty? A lot of the agency debts, that is the Freddie and Fannie Mae loans, have prepayment penalties that you have to pay when you exit the loan prematurely. And so that can cause or cost the investor a lot of pain if they haven't negotiated a reduced schedule of prepayment penalty, for example. Variable rate loans may have less prepayment penalties, but again, you have to look at not just the rate, but also the terms. Is it interest only early on? That will help you with cash flow. Is it principal and interest together? That will impact your cash flow as well. What's the amortization schedule? We're looking at a lot of deals right now in the construction space where amortization programs are in the 35 to 40 years as opposed to standard 30 years. That is huge when it comes to cash flow. It will help the deal cash flow better and provide better returns for the investors. What's the loan duration? Is it 5 years? Is it 10 years? And what's the leverage? So as the interest rate started to pick up, leverage started to go down because of the debt to asset ratios, so that the lenders are making sure that they're not given too much proceeds, so they're not super exposed in the risky market, which means we have to do a bigger down payment as high as 40% when the interest was high. And when you go with a higher down payment, it's a good thing that you have a less riskier investment strategy, but that means a ton more cash, and that will dilute the returns for our investors. So we always have to strike a good balance between loan to value ratio and not being super exposed, but at the same time, not being super conservative where the returns doesn't make sense for our investors. All right, moving on. So given that dynamic, it's, turbulent time, interest is dropping. People are asking, like, is this the right time to invest? Should we wait after the election? It's kind of funny because the election is November 5th and the next Fed meeting is November 6th. So a day right after the election, they're going to decide if they're going to drop it more or not. We'll see. But if you want to navigate that market, a lot of people will be like, okay, let's see what happens. Let the market settle down. Maybe the stock market bubble will bust a little bit. Maybe they were showing some positive signs about the economy, that after the election everything will be more real. So what is that going to do to the stock market? What is that going to do to the economy in general? Does that mean that the Fed will reduce further and faster than anticipated because the economy isn't doing as great as everybody says it is? Another phenomena that we're seeing, kind of like the gossip of the CFO world, is they just don't want to make any decisions until they see where the market goes. And major decisions for CFOs, are they spending more CapEx money on their investments? And surely they're not. And then are they going to do layoffs, big layoffs? Here and there you'll hear about layoffs in big corporates, especially in the tech space. But for the most part, CFOs is not to do any layoffs right now and see what happens after the election. So that is a scary thought if you want to think about it, because that means more layoffs are potentially coming in, and that means the stock market is gonna have a tough time. So from my perspective in real estate, this is a good time if you do the right things, and this is what I want to talk about, is how you navigate this uncertainty in interest rate. There's a lot of opportunities for us as interest rate goes down to refinance and release some equity back to our investors. So that's one. Another thing is, now that we anticipate the interest rate is going down, and obviously nobody has a crystal ball, but the economy isn't doing well, and we believe that we're going to see more reductions in interest rate, and the Fed indicated that would be the case. So leveraging adjustable rates is going to be to our advantage. Variable interest rates will be to our advantage. We can always have an insurance in case it goes the other way, added to the loan. So that's another strategy we can look at to minimize the risk. Another trick that we always do, since the market is relatively slow and there hasn't been a lot of volumes of sales in the past, I would say a year and a half, a lot of sellers are open to financing the deals in-house. So instead of making a cash offer, we're working directly with the seller, being the bank, and say, can we work with you and you become our finance directly? If you're not interested in cashing out fully, and you may enjoy some cash flow until the economy settles down, and we'll take it over. So fully. So another option, we do this with land a lot, where we work with the landowners to finance 75 to 80% leverage, and it balloons in 2-3 years. They enjoy some cash flow, especially if it was an inheritance property, for example. Another alternative financial option, we're looking at projects where the loan to value ratio is low. The main lender, the bank, is not giving us enough proceeds. So we're supplementing that loan with secondary financing, which is pref equity from family offices, preferred equity from family offices or private equity groups, and or mezzanine debt, which is a kind of like a second loan on the property. So that's always a good thing because some of those big private equity groups or private lenders in general are looking for cash flow, but they don't want to participate in on the upside when we sell the property. So that still relatively is a cheaper option for us to pursue as partners in the deal than just getting more cash to the table. Feel free to ask any questions as I'm presenting this. I know some of this might be heavy. I would say big picture, it's important to maintain a flexible strategy. And I'm very excited about where we're going next. I mean, we haven't done any deals since December of last year. And now we're lining 5 deals that we're just trying to space out because there's too many coming showing up. So there's a lot of excitement where we're doing more in a relatively short amount of time. Some savvy investors, they'll say, we'll stay on the sideline and see what happens. Some, our, investors are saying, let's see what happens until after the election and maybe the economy adjustment. And I would argue it might be too late, especially that the stock market is anticipated to slow down. So if you have money in the stock market, maybe it's a good time to start thinking about moving it. I see a hand raised. Go ahead, Omar.
So one of the option I've keep reading about on the internet is assumable loans. Does those really exist, or is just a trend that is doesn't have a reality?
Great question. And the reason I may say they may not be relative in late 2024. Yes, assumable loan is a thing. And a lot of people see this as another sort of flexibility around how you may navigate that. So you can assume the loan. Problem with assuming loans is if the loan interest was high, nobody's going to assume a high interest loan. So if you ask me, maybe in 2023, we were looking at a lot of assumable loan opportunities because the loans were taken in 2020 or 2021, and it was at 3% interest. So it's very attractive to go assume a loan at 3% on a property. But what was happening, they were putting a huge premium on those low interest rates. And nobody wanted to pay that premium because, basically you have to overpay $1 million or $2 million on a property to get that low interest rate. So it didn't make sense for the most part. But it is a good strategy that we use in our toolbox if it makes sense. Right now, we have seen tons of high interest rate in the past couple of years. So I would say it's not relevant today. It may be relevant in the future. Great question.
Yeah, got it. Thank you.
Just to show you like the types of lenders and that kind of just comparing 2023 and 2024. In 2023, the banks said, we're not doing business. We're just gonna sit down and not do anything. And we had a couple of projects we were talking to the banks around, and they told us maybe you should wait. And we're like, yeah, maybe you should wait too. We were kind of like, saying this is not the time to proceed. We had equity in the land on one of our Houston projects. We had the horizontal development ready to go, but we decided to just pause. And that was wise. And now we're talking to the bank and they're like, yeah, I think this is the right time to move forward. So I would say banks are moving. You can see here that they're lending more. And then sort of like the alternative lending is kind of slowing down. All that kind of creativity that we chose not to participate in last year is kind of slowing down. So kind of just giving you a comparison that if the banks are moving, maybe my theory and my thesis is correct, that this is the time to start going after this. We do have also some great news back in August and September. We started seeing big private equity groups moving as well. They're saying everybody's gonna kind of be conventional and wait, maybe this is the time to make a move. This is just kind of showing you that a lot of people didn't do real estate in the last couple of years. And so this is the volume of investments over the years. When interest rate was low, everybody jumped in, knowing what they're doing or not. And a lot of people are hurt who made bad moves in that season. And you can see now we're back to normal, and we've anticipated to pick up a little. Okay, maybe a fun question. If you had $1 million, how would you invest it based on these years? So just wanted to share different strategies on different timelines. So, if you had $1 million to invest in 2020 and 2010, this is right after the economy collapsed. This is when Michigan and Wisconsin and all these states had massive foreclosures, and prices correction was crazy. And so houses were selling pennies on the dollar. And I wasn't a heavy investors back then, but a lot of people that I know did, and they bought ton of houses, pennies on the dollar. I'm talking 10, 15 cents on the dollar. So that's like 85% discount. So if I had $1 million in 2010, I would have used it to buy deals cash. Nobody was lending anyway. So if you had cash, that was great. And it was the lowest basis you can ever buy. So right after a crash, go sweep. It makes sense. 2021, it was Wild West. Everybody and their brother jumped into real estate. Interest rate was extremely low. People were sugar high. They didn't have enough insurances on rate might be increasing soon. And typically you buy an insurance rate cap, a rate cap insurance that would say, even if it's variable, if it hits a certain number, it stays there and the insurance will pay for the difference. But to be fair, many of the seasoned investors also haven't seen this crazy Fed action of increasing the interest rate in the fastest spike ever in the history of the US. So I've seen a lot of victims of that, seasoned or not. But in 2021, the best decision would have been make sure you had insurance on your rates. So in case it goes up, it stays flat and insurance picks up the delta. In 2023, it was crickets. Nobody was investing. And we kind of debated this in the teams for a long time. I've seen a lot of people who are trying to be creative and do deals and maybe stretch reality, if you will. And we said, nope, we're not doing that. We're just going to pause, and we're going to continue to build the team and focus on the properties that we have and kind of survive that storm. The other thing we did is we started researching heavily on what niches we can look at into other asset classes. And so, we were always in the operations mode, and I was always kind of what's the next deal and what's the next deal. For us, we focus on taking care of our deals that we already had, and making sure they run well. And it gave us also a lot of time to focus on what's the next horizon for us. So we started looking at medical offices being the best niche in offices. We started looking at flex space, light industrial for the industrial segment. And we started looking at senior housing as a niche for multifamily. And actually, all of the projects that are coming in the pipeline are under these categories. So we're going to continue to focus on senior, flex space, and medical offices until multifamily is back, and we'll be participating, but we're not in a hurry. In 2024, we've seen a new market correction. It's not as severe in 2020, 2010. And 2024, most of the deals that are on the market today are discounted 25 to 30% from what they were, I would say, at the peak early 2022. So a lot of people who bought deals in 22, I would say 2020 or 21, and didn't have the right structure for them are hurt, and they want to just exit these deals. And so if there's any deal that is worth buying right now, it has to be discounted, and it has to be discounted enough. So that's the strategy for 2024 for us in terms of financing, is We have a low basis. We stick to the fundamentals and nothing crazy. The other thing is true value add. So there were a lot of deals where people kind of gonna rely on the market helping them. So they buy here, the market is growing, you sell high, everybody thinks you're a hero. We're back to fundamentals now. You have to buy right, you have to have a low basis, you have to have runway on value add and make sure that you have opportunity to improve rent, to improve revenue, to manage expenses well, and no market saving the day anymore. So you have to go back to the fundamentals and not get lucky again, like many people did in the late teens. I'll go through some of the case studies really quick. I think we covered a lot of these examples, but here's a case study where we bought a property in 2022. The initial rate, it is a variable rate, but we did buy insurance for 3 years. And the debt service was manageable. So even as interest went crazy, and some properties who didn't have rate caps ended up paying 9.5%, 10% interest. Ours capped at 5.85. So that helped us a lot from a debt service point of view. But as we got closer into the end of that rate cap insurance, we started looking into, can we refinance? Can we change? Can we lock in into a new interest rate and what that new debt service would look like? We managed to work with the lender directly and said, hey, listen, nobody's going to refinance these days because it doesn't make sense to refinance on most of the properties in the market. What can we do to get to modify the loan? Now, historically, that was a big deal. You didn't talk to lenders about modifying an agreement. They would like foreclose on you and like, take you to court, whatever. But we had a very good negotiation with them, and we ended up actually converting the loan into a fixed rate loan and deferring some of the interest till the exit as well, which gave us a breathing room on the cash flow as well. So it was a win-win situation. The lender loved our operation, our kind of trend on the revenue and our managing the expenses. And they said, you guys are the best to continue to run this property. So let's have an agreement that is a win-win for both of us. So that's a great case study where we managed the interest as it was growing crazy, and then working with the lenders because everybody was in trouble at that era. So that's one example. Class C kind of value add property. Another case study is we're developing a flex space in Oklahoma City. It's a new development. And the general consensus is nobody should be developing anything at this point because interest rate is still high, construction cost is high, and rent's relatively flat. So it doesn't make sense to develop new assets. But we were always talking about like, how can we make this work? And started introducing multi-phase approach to things, is using the money when it's fully needed. So we'd go with equity and buy the land, and then bring in a small amount of investors to actually go do the horizontal development, developing the land, then into another phase where we go vertical. And so we kind of manage the injection of cash, and the cost of capital becomes more manageable. And so pref equity in phase one, we're going to work with the local bank on the construction loan. That gives us a good loan to cost ratio, subprime, and we'll only use it when we need it. Another feature that we worked with the bank on is we're going to have a built-in conversion to a permanent loan. So this is going to be one loan with the bank where we're going to have the construction loan, and once we are stable, we'll convert it into a permanent loan with much better loan terms. So if you think about this, there's an element of we're delaying the need for the cash. We're not exposing ourselves on the land and the horizontal development. It's all equity. And then when we rely on the bank, it's very limited time when we do the construction loan and we convert into a permanent loan. So even with the constraints of what I talked about as a high interest rate and the constraints of relatively high construction cost, the numbers made sense when we did it this way. A third case study is a Houston apartment Class B. We bought this, when did we buy this? This was I would say early, this is late 23. So discounted 30%. That was a great starting point because somebody overpaid for this property. And we said, we're sorry, here's what it is now. And they agreed to that. So low basis was great. Agency debt was low 5 because it was assumable loan as well. And it's a long hold. We're going to have a full IO. We're going to enjoy the interest only for the next, I would say, 3.5 years. This is a property that cash flowed within 5 months, and we started doing distributions to our investors. It's kind of like a rare story to do distributions in 2023, but we did it. And it's a true value add. There's no, we're going to put lipstick on a pig kind of approach. This was a true value add, real renovations of the unit, improving the rents and the whole amenity set of the property. I guess I showed you a lot of examples, but the whole idea was to illustrate that you can still do great deals even in uncertain time if you know what you're doing, what asset classes, what markets, and what's the right finance structure for your deals, and being flexible along the way, as opposed to everything is uncertain, I'm not doing anything, let's see what happens. I'm gonna probably skip some of these, but I'm open to questions. There's some tools that we use to look at more experts kind of crystal balls, because we don't have a good crystal ball, but we look at other experts' crystal balls. There's a lot of good resources around where the 10-year treasury is and where it's anticipated to be. SOFR is used typically to determine the basis of variable loans. Where are the rate caps? We continue to monitor what the market is doing in terms of how much the prices are for an apartment in Houston, what the prices are for an industrial warehouse in Oklahoma City. And so we continue to monitor that relationship that I was talking about. And prime rates are typically more for local banks, not less institutional money. Again, when we look at deals, we use all kinds of creative approaches. The phased approach I talked about, refinance calculation. When do we refinance? Do we need to refinance throughout the deal? Is it a good idea to refinance mid-deal? Is it a good idea to just sell the property instead of refinance? So we look at that option. Do we hold it for 3 years? Do we hold it for 7 years? We look at the investor classes as well. So people who invest more money might get different returns than people who invest smaller amount, but also they may be guaranteed on cash, but not get money on the upside. So that pref equity or preferred equity I talked about. And then the flexibility of, are we doing a value add on this deal? Are we approaching this as a turnkey or a ground up construction? And the difference is, we have an underwriting model for all of these variations. So when we look at a deal, we'll say, okay, the business plan is we're going to do a value add and we're going to have a permanent loan from day one. Or we're going to do a ground up construction project and we're going to do this phased approach with a refinance. So all of these combination, we make sure we have a template for, so we're not cutting any corners. So just quickly, here's some examples of some of the tools that we use. This is an example of a bridge debt, which means it's a variable. It's kind of like a bridge debt is normally like a construction loan, or if you're not stable and you want to renovate heavily the property, you might get a bridge debt before you get into a permanent loan once you hit your milestones. And then here we're saying, okay, after we do the bridge debt for 8.5%, we will go ahead and convert into a permanent loan at 4.5% after 3 years. So 3 years of a bridge debt, and then we'll continue on with a long-term low interest loan. And we also look at, what's going to happen if we refinance, what's going to happen if we sell. So we always have these combinations handy to make sure that we have the right business plan. We're refinancing here, for example, at 3 years. and exiting the project at 5 years. Another example, this is only a stabilized debt, meaning long-term debt from day one. What's a down payment? 26% at 6%, 26% down payment. The interest rate is 6%. 5 years interest only, amortized for 30 years. So that's another one that we're not doing a refinance on. This one, actually, we were doing a refinance. This example where we're not doing a refinance. So I don't want to bore you with this, but it's just an example of kind of taking all these scenarios into account. Gives us the ability to be flexible and continue to have deals in I would say, an uncertain time, according to many. With that, I'll pause here. Thank you for listening in. I'd be open to all the questions.
Yeah, we've got one question in the chat about the markets that we're focused on right now.
Absolutely. Yes, great answer. Great question, great answer. Yes, we love Texas. We are in Texas. We'll stay in Texas. But we also love all the states around Texas. So we are doing deals in Oklahoma City, in the Oklahoma market. We'd love to expand north to Kansas and east to northwest Arkansas down the road. So we do Houston, and Dallas and Oklahoma City. And within each city, we are focused on certain zip codes. If I turn my camera, I have this 6x8 map on the wall where all the zip codes, red, yellow, green. Now we go zip code by zip code, and some cities like Houston, we have no zoning. So sometimes you go road by road when you have no zoning. But Dallas and Oklahoma are better.
I got a question on the credit worthiness. For personal loans, banks looks usually at the credit scores. For how does it work for commercial lending? Usually, what are the lenders looking at? Do they have specific history that they look at, or how does it work?
Absolutely. With commercial lending, it's a little different. The main criteria is net worth being higher than the loan amount of the general partners or the sponsor of the deal. So typically investors who come in as passive investors has nothing to do with the debt. They only deal with the equity, and they get all the benefits from appreciation, taxes, etc. But on our side, the active investors, the sponsors of the deal, and general managers, they look at the collective net worth of all the managers and the liquidity position. So the cash position or the liquidity position of the general partners. Those are the two key. And then obviously a good resume in that specific asset class. So if you're taking an apartment multifamily loan, you need to show a good resume that you've done these deals before. But the main two criteria are the net worth and the liquidity. Unlike normal mortgages on the houses where it's more income and credit score, it's a little different. Yeah, absolutely. I would say we became, on the traditional acquisition, we became super conservative. If it doesn't pencil out at basic assumptions, we're not even looking at it. So is it discounted 35%? What's the story? If there's no story by the seller, if they're not pinched, if they're not supposed to sell anyway in 2024. Nobody's supposed to sell. So if they're selling, we need to know the story, and it better be real. And low bases, and we said pass on 99.5% of the deals we saw. On the new development, as I was explaining, it's that flexibility of how to use smart financing structures to make development deals work. And what's nice about development now is we're spending 2024 and 2025 on development, meaning we're going to buy the land, we're going to do the horizontal. We're not really doing vertical anytime soon. So we're actually gaining traction and ahead of other developers who are just waiting for maybe the situation to get easier. So we're buying time, if that makes sense. Paul, are you underwriting any rent growth? No rent growth for 2 years is kind of the simple rule I have. And then normal rent growth after that, nothing crazy.
Good
Great
questions,
questions.
everyone. Yeah.
Are you factoring higher exit cap rate or not anymore. So Cash, what we are seeing, and I'm happy to kind of show you more nerdy data, but as interest is going to drop, there's going to be a lag, and then cap rates are going to shrink again. So it's going to get worse. Valuation-wise, it's going to get worse before it gets better. So the general rule of thumb, I would say I always look at what is it now? What is it now? So just to kind of stay safe, it's going to get worse and then kind of stabilize. And if you have a right basis, if you're buying at 2019 prices, that's your good low basis, and then assume exit cap to be relatively the same of today.
Al, could you specify when you were mentioning underwriting? What do you mean exactly by that?
Oh, underwriting is our process to build the financial model for the whole project. So we look at what are the inputs. It's kind of like when the insurance does underwriting on you before they give you an insurance. It's basically just analysis. Underwriting means analysis. So we
Okay,
look at
like
all the inputs. We look at what's a rent, what's a cost, what's a finance structure. Is the market gonna grow? Is it gonna shrink? And look at Sam, she's ahead of me. We have a full lecture about underwriting if you like to watch that. It's on YouTube.
oh, makes sense. Yeah, I'll definitely have a look.
Great.
Yeah, I put a few different ones in the chat based when you were talking. I was like, oh, cap rate, cream of the crop, underwriting. So yeah, if you want any of the things that Al mentioned in detail, they're all on our YouTube channel.
Appreciate everybody's input, questions, and participating today. As always, we do this every month and we'll be communicating our webinars. Typically in the middle of the month, we do the virtual webinars. We also have a local meetup here in Houston for the Houston folks. We do that last Wednesday of every month. And you can follow us on YouTube, see all the lectures that we've done so far. We try to bring different topics every month. So if you're also interested to learn something specific that we haven't addressed, feel free to reach out and be happy to do that in the next cycle. Appreciate everything that you guys did today. Have a great night.